On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberg. Joining me today is Ryan Dietrich. He is the Chief Market Strategist at Carson Group and also the co-host of the Facts versus Feelings podcast. We'll get into that a little bit later. But Ryan, I do want to talk about this bull market right now. You've been very bullish all year long, even during the February and March pullback. What's giving you confidence, though, with the current bull run? Do you see this as just a basic melt-up, or is there something bigger that might break here?
Well, you want to start with something easier? No, Todd, I'm excited to be back. Thank you for the invite. This is always a lot of fun, so I really do appreciate it. Yes, the Carson Group, we have been bullish, and it's not necessarily just this year. I mean, I've come on with you for a couple of years now. We've probably said about the same thing, that this is a pretty significant secular bull market, and we think we could have a lot of life left to it. And this year, everybody got all bared up, right at the end of March, all the worries, and very valid worries. But then one of the things we were talking about, I'm sure other people said this, so I'm not going to spend too much time on it, but you look at earnings, S&P 500 12-month estimates for earnings are up 11% this year, right? The S&P, the time we're doing this, is up like 8% or so. So, you could have said, well, stocks are expensive. Well, not really, but even then, stocks are technically cheaper now than they were at the start of the year, which kind of usually upsets people when they hear it. But I'll just go one more kind of big picture thing, then we can dive more into the weeds, right? This bull market is 3.5 years old because the bear market ended October 12th, 2022. So 3.5 years in. And when you look at history, Todd, actually, that's not that old of a bull market. I know it sounds like it might be, but it's really not. There have been 5 others the last 50 years that made it to at least their 3rd birthday. The shortest any of them went was 5 years. The average was 8 years. Right? There's lots of ways to slice and dice it. One more, put a cherry on top. We're up 100% now on this bull market, right? So I found 7 other bull markets that made it to at least a double. On average, those other 7 lasted another 3 years. Now, some were shorter, some were longer. I get it. Like the 2007 peak was right about 100%. Yes. But the reality to us, the underlying pinnings, which we'll get into, the rest of this conversation, are still solid. And this bull market's probably younger than you think.
So you have maintained a 12 to 15% upside target for the S&P 500. I mean, is it based off of earnings? We still have this Iran war that we have to worry about as a headwind. But earnings have been strong, like you mentioned. You have obviously the tax code that has actually helped with the Big Beautiful Bill Act, and also AI CapEx spending. But what do you believe is going to be what's meaningful that's going to push this stock market even higher for the rest of the year?
Yeah, I mean, honestly, a combination of some of those things you just mentioned. Now I'll dive a little more into it. At the start of the year, Carson Group released our 2026 outlook. We called it Riding the Wave. And one of those waves indeed was CapEx spending, right? If you look at the big 5 hyperscalers at the start of this year, they were expected to spend $515 billion, which is a lot of money on CapEx and CapEx investment. Well, Todd, after this recent earnings season, it's up to $740 billion, right? To quote Bob Uecker from the famous Major League, just a bit outside, but in a good way. I mean, that spending is real. Now, listen, the reality, the consumer, though, is okay, I think is the way we'd put it. We got GDP data recently. The consumer was a tad on the weak side there. We're optimistic, though. Well, if you listed all this stuff, right? I mean, fiscal policy, potentially monetary policy. We don't think the Fed's going to be hiking anytime. We don't think the Fed's going to be cutting. We think it's going to kind of keep the status quo. Yes, earnings are strong. The consumer might come back. But I want to focus on that because I don't think as many people talked about this. The second half of this year, we're optimistic that the labor market is going to improve significantly. We just had 11 months in a row of alternating up, down, up, down, up, down, jobs growth, job subtraction. That's the longest ever by a mile. Now, we just had 2 positive months in a row. We look at things like the unemployment rate, 4.3%, kind of hanging tough. Look at prime age workers. That's age 24 to 55, I believe is what it is. It might be 25 to 54. It's one or the other. Close enough for government work. Prime age workers, 80.7% participation rate. Okay, what's that mean? That's like the highest in 25 years. Initial jobless claims are still hanging out around 200,000. I mean, the labor market is not perfect, but Sonu Varghese, work with him. He's our chief macro strategist. He dives into stuff all the time. He's been saying all year the labor market's a little bit better, and now we're starting to see some better data on that. So if the labor market comes back, consumer confidence might come back, consumer spending, which has been solid, will maybe even do a little bit better. And that'll just be another potential driver the second half of this year because we're all talking about the same stuff: earnings, AI, all that stuff. But I think the labor market's one that a lot of people aren't talking about that we're optimistic could drive the second half of this year.
You are right about that. We had 178,000 print 2 months ago. Last month, 115,000, much stronger than what Wall Street whisper numbers are even giving us right now. So there is some validity to that statement.
Yeah.
Last time you were on, you gave us a great quote: banana peel sell off. What signals told you that when we had that 9% pullback,
Mm-hmm.
that was a great buying opportunity rather than the start of a bear market?
Well, thank you for remembering that. At the start of this year, we had the big rally. We were on record. Yes, we're bullish. I mean, people, oh, Carson's always bullish. Well, I mean, yes, we manage money and we think the market's going higher for a lot of reasons. But we were anticipating what I was calling a banana peel sell off sometime in February, sometime in March. Because you look at historically, after a big year, you tend to have weakness early. Once you get past January, oh, by the way, it is a midterm year. Midterm years, the first quarter is usually pretty weak. Second quarter can be a little weak as well. So those are some factors. And everybody was all of a sudden bullish. I mean, everybody's all excited. Everyone said how great everything was this time in January. And I'm looking around like, where were all these bulls, on the way up? So that worried us that we might have something. But then on that 9.1% peak to trough correction on the S&P 500, which is pretty standard. Your average year sees about a 10, sees like, put it this way, like over half the year see more than a 10% peak to trough correction. Midterm years usually have even a little bit more. So we were anticipating, we said in our outlook start of the year, we might see as much as a 15% peak to trough correction some point during this year, probably the first half. Then obviously everything that happened where we had, Todd, this is wild. We had a 6.1, I think, sigma event when you look at crude oil, how it doubled virtually like overnight. That's supposed to happen once every 4 billion years. All right. Well, it happened this year. So congratulations, everybody. But we saw some different things that took place there, but over the top fear and negativity at the end of March. And trust me, we managed a lot of money. And when you see the market doing what it's doing, everybody, it wasn't a question of when. I'm sorry. It was if we go into a bull market, I'm sorry, I'll get there. If we go into a bear market, it's when we go into a bear market. Everybody and their mother expected stocks to go into a bear market at the end of March and early April. And fortunately, we started to see, one thing Burt White, our CEO, says, it's not about good or bad. It's about better or worse. Stuff's started getting a little bit better. The market sniffed out huge earnings and and continued good news out of AI, and those things sparked the big rally. And honestly, at the end of the day, we still think this is a secular bull market, meaning it probably has, like I said at the very beginning, maybe a little bit more life, a couple of years left, maybe potentially. When we look at the rest of this year, we do think the upside for 15% on the S&P 500 makes sense. Now we left that there back in March when we were down on the year. It felt you look up, it's like, ooh, that's really far away. And now here we are. I mean, one more thing on this. I mean, it's just wild when you look at markets. Technology was up 20% last month, right? I mean, that is an incredible move. But we've been slightly overweight technology, this whole time. And we said the whole time we needed tech to come back to get the market up to our 15% potential target. Well, that's happened in a big way.
Yeah, no doubt about it. Semiconductors have been on a tear. The Philly Semiconductor Index itself continues to set records. So it's been remarkable. Yeah. So what would have to happen to break your bull market thesis?
Yeah. A couple things there. So Sonu looks at the macro backdrop very closely. And if he starts to see internal deterioration in the economy, well, that would be a worry. We're not seeing that. I want to be very clear. But from what I look at, I have a CMT behind my name, Chartered Market Technician, and not to be confused with country music television. I do not sing country music. Maybe after a few beers, well, you and I want to go out sometime. Maybe I could. But until then, we're not going to do that. I'd say there's two things I really like to focus on. Right. The first one is market breadth, right? Various advanced decline lines. What's an advanced decline line? A cumulative basis, how many stocks go up versus down every day. Now, what you tend to see at major peaks, breadth tends to lead price. I learned it that way a long time ago. So if breadth starts going lower, advanced decline lines start going lower, but the market's going higher, that's a warning sign. Doesn't mean you have to go down immediately, but that tells you there's weak underpinnings. Well, just last Wednesday, all right, the New York Stock Exchange, NYSE, advanced decline line, hit an all-time high. That's a positive sign. Yes, technology has done really, really well relative to everybody else, but it doesn't mean everything else is falling apart. The time we're doing this, right? Japan is hitting like all-time highs, Nikkei above 64,000. China's breaking out to four-year highs. Obviously, U.S. has done very well. I mean, literally, most global countries have done well. Emerging markets are up 23% for the year. All right. I mean, U.S. up about 8 or 9 the time we're doing this. Most developed countries up. So it is a very, in our opinion, broad-based bull market. I like that. The other thing I like to look at, yes, you can follow a lot of a lot of fundamentals, right? I like to keep it simple. I'm not that smart. I like to keep it simple. I look at credit spreads, right? Various triple B spreads, high yield spreads. I've always learned it this way. If there's trouble, or I'm sorry, put it this way. If there's a monster under the bed, the credit markets will sniff it out. Even, oh, actually, to answer your question a little bit ago, when we had that 9%, almost 10% intraday pullback, credit markets weren't freaking out. Credit markets saying this is not like some systemic first domino that's going to fall and knock everything over. It's just a lot of years have volatility, and that's what we were dealing with. So if the credit markets start to see stress, if you start to see blowing out of spreads in various credit spreads we follow, that would worry me. Well, again, the good news, we're not seeing that at all right now, and we have pretty strong breadth with a new high on the advanced decline line just last week. So those are two things I want, well, I shouldn't say I want to see, but if I start to see that, it would change our tune from being overweight equities. Now, one more, just to give a little more weeds, we manage almost $8 billion on our team. And you think about a 60-40 portfolio, that's kind of your moderate portfolio. 60% stocks, 40% other stuff. We're probably about 68 to 69% equities, about 50% US. A good chunk of the rest is emerging markets and developed international. But that other stuff, the other 31%, we've been underweight bonds for a while and short duration for a while because we've said, and Sona's been all over this, we're in a higher inflation world. We think we're more like a 3.5% inflation world versus 2%. That's not a bad thing. People hear, oh my goodness, inflation 3%. Oh, it's got to be horrible. No, not at all. I mean, we think we're going to have good economic growth. We're going to have, again, a little bit higher inflation, and we're going to have a Fed that's not going to be hiking. We don't see the Fed hiking. You don't see them cutting either, but in a way, Sonu said, that's kind of a Fed is almost easing in a way, and the market likes to see that. So when you smush all this stuff together, there's a lot of reasons that we have positioned the other stuff in our portfolios to have things like managed futures, short up duration, have some cash, had some hard assets, some real assets, different things, because bonds, honest to goodness, have not done well for 5 years, and they're like flat the second we're doing this. So we would say keep that, diversify your diversifiers, the other bucket of stuff, not just stocks, your other stuff, to be more diversified away from bonds. And that's how we've done it. It's really helped our performance. We think that might be a second half story as well.
Interesting. So let's talk about the Fed a little bit. You've been in the camp of talking about higher inflation, a dovish Fed, strong growth, basically a hot but healthy economy. Yeah. Is this still the sweet spot, do you think, Ryan, or do you believe inflation may be rising to a dangerous level?
Yeah, we don't think inflation is at a dangerous level. I mean, that's a great question there. I mean, but again, for almost 2 years, I think we've been kind of in this camp that inflation's probably going to be running closer to 3%, not the end of the world. I mean, so again, Sonu looks at things like core PCE, right? That's the Fed's favorite measure of inflation, 178 components to core PCE. When you peel back that onion, this time a year ago, about 45% of the components were running at 3% year-over-year inflation. Okay, what's that mean? Right now, it's 54%. So, Todd, we're seeing, like I mentioned, broadening out a little bit ago, we're seeing a broadening out of inflation. That's not the end of the world, but it's just important to note that, listen, if the economy does okay, but the interest rates stay higher, well, and inflation is a little hotter, well, bonds probably don't do as well. That's exactly what we are seeing. Now, with the Fed right now, I mean, it is what it is. I've got, you can see on the screen, I've got pretty big ears, right? I have pretty big ears. So I try to listen as well as I can. And the reality is we have a new leadership coming at the Fed, right? Warsh is coming in. We know that. What's he saying? I mean, he's saying AI is deflationary longer term. So I don't disagree. I don't think anyone in their right mind says 10 years from now, AI is probably going to be deflationary, maybe 5 years, maybe 2 years. But right now we're a little skeptical, but he's not, we just don't see him coming in hiking right away. And who knows what happened behind closed doors with he and President Trump. But what's President Trump want? He wants a couple of rate cuts. Maybe you get one rate cut, although I think it's going to be hard for him to do. But we sure don't see any hikes. I mean, they're all, like the Atlanta Fed, different places have the data and like, oh, will the Fed hike? Will the Fed not? This time, maybe 4 months, three or 4 weeks ago, maybe longer, 6 weeks ago, we were talking about Fed hikes. We never bought into that. We didn't think the Fed's going to do that, even though maybe they should. I want to be very clear. Maybe they should. With our back, look, with how we see the economy hanging in there, a little hotter inflation, maybe they should hike once or twice. I don't think that'd be the end of the world. But the reality is they're not going to. And the last time we had a strong economy with a little bit hotter inflation with a fairly dovish Fed was the late 90s, right? Stocks went up 20% 5 years in a row back then. I'm not saying that's going to happen again, but history, can repeat itself, right? That's what Mark Twain told us. History doesn't repeat itself. It often rhymes, Mark Twain. So there's some similarities here with what's going on with the AI revolution now and the internet revolution then. So we'll see. But I think being overweight equities and still using monetary policy as a potential driver, as we quoted in our outlook, ride the wave, that there's still a driver from the Fed being a little bit more dovish than the market was expecting this time 6 or 7 weeks ago.
And you've remained underweight on the bond side. Is there something that can change that can make bonds more compelling for your portfolios?
Yeah, absolutely. Let's say the economy really starts to crater. I mean, that would be the answer, right? I mean, if the economy really starts to slow down, bonds, that means the Fed probably would cut a little bit more, right? And maybe inflation is not such the worry if the economy slows down. So that would be the one area, I guess, that would do it. But again, I guess to be clear, we're not seeing that. And I will say, our buddies over at Bespoke, I'm sure you probably follow Bespoke before. They do a lot of good work. They shared just today, I think on X, the searches for the word inflation on Google Trends are like the highest in years. Now, not too surprising. But when I start seeing stuff like that, I will say it catches my attention that everybody realizes inflation's been hot and this and that. Maybe they realize bonds aren't doing that well. I'm not saying we're adding duration yet, but we have meetings all the time on our team, and I brought this up that we're eyeballing that. Let's say the 10-year goes to 450, 475. Listen, for the right person, I'm an investor. I'm not a trader, so I just want to be very clear. But for the right investor, that could be a potential spot, for fixed income. But honestly, we don't think we're there yet, and I still think you want to have a diversified bucket in that diversifier over there.
Do you still see tech and semiconductors as really the leaders of the pack here, or maybe financials and industrials are just underappreciated right now?
Well, a good one there. I mean, clearly the leader is semiconductors and telecom. Like you've seen telecom. It's not your father's telecom. What's going on there? So clearly those areas, and we know why, right? All the chip shortages and AI, and we all get it. There's incredible demand that doesn't seem to slow down. Those are the leaders. But from a investments point of view, portfolio point of view, we're slightly overweight technology, yes. But this is crazy. I didn't even realize this. Year to date, technology up like over 20%, but communication services are down. Right. I mean, they used to kind of be similar, right? They were like cousins to each other. So that kind of tells you it's real centralized to certain areas. But then you look around and industrials are having a really good year. So we do like industrials and financials. And what I like about financials, as crazy as the move has been in these technology names, let's be clear. I mean, I don't have them off the top of my head, but like the SOX is historically above his 50-day moving average. And these moves we've seen every time you turn around, Intel's up like 10%. The government owns a lot of it. We might pay off all our debt if Intel keeps going up the way this thing's going. But we know that rubber band's going to come back to a degree. So be very careful. And we are, again, slightly overweight tech. I'm comfortable being there. But I look at something like financials. My financials have struggled. That's fine. Well, it's not fine, but it's what it is. But maybe as tech pulls back, financials and industrials take back that baton, because we think being in the cyclical areas of the economy, tech, industrials, financials, those areas of the economy keeps doing a little bit better. The second half of this year will do well. So I think it makes sense to have that to be diversified in this world with different parts of cyclicals. One more comment on this is an old school CMT, right? I look at the message of the market. John Murphy passed away earlier this year, a mentor of mine. I've read all his books and learned so much from. He says, look at things like what's leading the market. Well, what's leading the market? High beta is breaking out relative to low volatility. Momentum is breaking out relative to the S&P 500. Staples on an equal weight are breaking to new 52-week lows relative to the S&P 500 equal weight. What I'm getting at, the right stuff is leading this bull market, and who knows when it's going to end. But I think the reality is the rest of this year, I'd still be pretty optimistic that this bull market's not done yet.
And it's going to continue in 2027, I presume you're thinking.
Yeah, we think so. I mean, listen, we'll cross that bridge when we get there, but I think there's a very good chance of that. And let's be clear though, it's not going to be easy. What happened in 2000 and well, 22 was a terrible bear market, but since the bull market started 2023 March, everybody was very worried, rightfully so, about the regional bank crisis. That was a real scary time in March of 23. 2024, what happened? August, the yen carry trade unwind. We went to sleep one night. Japan was having its worst day since the
Yeah.
87 crash. Well, Japan's hitting all-time highs right now. It's a long way from them. 2025, the bear market we had around Liberation Day and the tariffs and all that stuff. And now this year, there's the war. I mean, every year is going to have scary headlines. Every year is going to have volatility. Volatility is the toll we pay to invest, what we like to say at Carson Group. So there's going to be something crazy. Now, one more on this. I think it's neat. Your average midterm year pulls back 17.5% peak to trough. Now, we just pulled back like 9%. Okay. So maybe we could have a little bit more potential pain somewhere later this year. I don't know. I'd put that on a coin flip if it happens. I think we might have just had the major low just recently earlier this year. But still, 1 year off those lows in a midterm year, the S&P 500 since 1950 has been higher every single time, up almost 33% on average. Now, I don't know if we're going to be up 33% from the March lows we had recently, but you know what? We're up like, 16% or something off those lows already. So, they're very well could. Momentum begets momentum is something Sonu says a lot, and he's smarter than I am. So I'm not going to fight momentum.
That's incredible. One final question for you. What is the most dangerous macro risk out there that
Yep.
investors are ignoring right now?
Yeah, so I've kind of hinted at this. I love it. Hopefully, wrapping it up with this one. Overheating, right? I mean, the economy might start to improve. The labor market might start to improve. Inflation might continue to be a little higher when you look at what's going on. I mean, the time we're doing this, copper's at an all-time high. Now, normally, copper is a good sign for the global economy and demand and these things, but still, a lot of these base metals and grains and corn and soybeans and a lot of these things, they look like they want to go higher. So inflation continues to go a little bit higher, but we have the Fed who says we're not too worried about that because we think this is a one-time shock, and down the road, AI is going to be deflationary, which again, I don't totally disagree with, but I think the biggest worry we have is a potential policy mistake because of the Fed. Put it this way, if there's no rate hikes this year and inflation runs a little bit hot and the economy is just fine, you know what? That's a very, very bullish trifecta. But the reality is if things keep going and keep heating up a little bit, you're going to have to pay the piper somewhere. Now, is it a 2022 type of scenario? Because honest to goodness, the Fed probably should have been hiking in 2021. Whenever I got money from the government, they were day trading, SPACs were going crazy. It was just wild what was happening, and things were a little too hot. And the Fed then, different leadership, I get it, but the Fed, we think we're behind the eight ball and should have probably been hiking a few times to slow it down. Then they started, hiking a whole bunch in 2022. We had a 25% bear market. Oh, and by the way, bonds had their worst year since George Washington was president, right? So it was a horrible year for investors back in 2022. So that's a worry. That might be more of a 2027 thing. I'm not saying it's going to happen, but that's something that gets us, Todd, is if things get a little too good and we have a Fed that maybe says, let's not pump the brakes a little bit, that could get us in trouble down the road here, down the road in 2027.
That's right. Well, one thing that is not overheating is you, Ryan Dietrich. You got a lot going on these days, one of which is the Facts versus Feelings podcast. It's coming out on Wednesday again, correct?
Yeah, that comes out every single Wednesday. Sonu and myself, we do that weekly podcast. Honest to goodness, Todd, we talk about everything you and I just talked about. We talk about whatever's in the news, whatever the markets are doing. And I think what's fun about our podcast, a lot of people have podcasts, well, I understand that. There's a lot of good ones out there, no question about it. But we manage real money. And we a lot of times talk about, okay, well, here's what's happening with the Fed. What does it mean to a portfolio? We like to take that one step further for a lot of people and try to really benefit and show what we're doing, managing billions of dollars. And we just got some of our returns the last 1, 3, and 5 years. And we've had some really good performance. Listen, yeah, because we've been bullish, the market's gone up a lot, but it's not always that simple. I mean, even when we had the big sell-off back in March and we were bullish, we hung in there very, very nicely because, again, we did some different things. We're not just all about Mag 7 or this and that. We have diversification out there, but we're looking at the world, I think, hopefully the correct way to help people reach their long-term investment goals.
Amazing. Love it. I can't wait to see it every week, every Wednesday. It's awesome. I definitely invite the audience to go check it out. You will not regret seeing Ryan to give his analysis every week. It's awesome. Ryan, I want to thank you so much for joining me today. I know you're very busy, especially with this bull run going on, but I do appreciate you taking time today to join us.
Well, Todd, one more. How about my Bengals? What do you think? Off season?
Oh.
I don't know. You're a Raven. I know. We'll see.
I know. We were lucky. We were lucky with, obviously with Trey Hendrickson and, coming over. So, but I don't know.
He's good, but he's bad against the run. So I'm warning you now. He gets you a sack or two a game, but he's bad against the run. So we'll see. But it'll be fun when the Bengals play the Ravens. Have me back on. We can make a little friendly wager or something.
I cannot wait for that.
Yeah.
We definitely will talk more about that in the next few months. Yes. That's for sure. So Ryan, thanks again for joining me, and definitely wish you all the luck in the world with everything that you have going on. And on behalf of Ryan Dietrich, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up at 3 o'clock live today, Joe Madden is going to have a very special Madden on the line. You will not want to miss what she has to say. It's a very exciting show. Can't wait to see you then. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.